Welcome to the Yoked Podcast, where we talk about all things entrepreneurship, real estate, and partnerships. I'm your host, Travis Hall, alongside my co-host and wife, Ingrid. Together, we've been in real estate for nearly 2 decades, always as an equally yoked husband and wife team.
Join us each week as we bring you a new episode. And as always, be sure to like, subscribe, follow along, and welcome to this week's episode of
The Yoked Podcast. What's up, and welcome to the Yoked Podcast. I'm Travis, and this is Ingrid.
Hi.
And on this episode, we thought it'd be fun to just chat about creative finance and all things. It's going to be super high level. We just did an education course with a bunch of realtors about this specific thing. We're like, you know what? Let's just record a podcast about it and chat about it. So today's conversation is all about creative financing and what it means to do creative financing, how to do it a little bit, some of the terms, just really high level.
I think, too, it is an opportunity to educate the general public, but also if you're a realtor or broker on this listening to us, it's important for another tool in your tool belt. I think it's a curse word right now in the industry, just from a realtor or broker lens. And we're here to tell you it should not be that. It should just be another offering for your clients. And if you're not offering it, hopefully this encourages you to do that.
It should be. Well, and we had a conversation just yesterday with a friend, contractor, realtor, like a partner that we have, talking about, an option, just in the real estate world, because we just did it. We just bought a house on creative finance, and he was asking, how does it work? And he's like, more like, dude, I need you to explain that to me at some point. And there is so much that you can explain. We are in a community that we talk a lot about this, about how it works and the intricacies, and it's pretty fun because in the traditional world, this is the way I've been explaining it. In the traditional world, the realtor world, you look at a transaction like this, and it seems like in the creative world, it's like you're playing over here. This is where we're playing, not here.
Exactly.
So it's been fun. So let's just dive in. Number one, we have our slides that we did for our education class.
They're called show notes. In the biz.
We have our show notes. So number one, just in general, what is creative financing? And so we kind of have it broken down into 3 things. Number one, it is a way to purchase and sell real estate that doesn't use a traditional lender. So the normal closing, normal purchase and sale, unless it's cash, which is always great. If it's a normal finance transaction, you go, get a lender and you qualify with the lender. And they say, hey, Mr. Travis, you are qualified for $5 million. And your mortgage payment is $35,000 a month. And then you go buy a house and you have a monthly payment, and there's all the escrow, there's the appraisal, and all the things that the lender, all the boxes that have to be checked in a creative finance transaction are necessary, right?
Yeah.
As a general statement.
Yes.
Number 2, it is a way to purchase and sell real estate where you can control the price and the financing terms. In a normal transaction, there's not really a teeter-totter. It's one side. You can offer less, you can offer more, but that's really price.
And what we're talking is about financing terms. Right now, you go to get a traditional loan with a lender, whether that's FHA, VA, conventional, jumbo, they're going to tell you what the rate is.
Correct.
You can buy down the rate, but only to an extent, using concessions and this bucket of seller and this bucket's from you. And so we're not talking about terms of the offer, like, okay, we're going to do this at appraisal. We're going to offer you these dates and deadlines. It's specifically with lending terms. Yeah,
the terms of the deal, like what you just said. Anybody that bought or sold in 2021, 2022, you understand the terms. You offered terms, meaning I'm not going to get an inspection. I'm going to waive my appraisal. All those are terms, technically. But what we're talking about is I can, here's the price, but I also want these financing terms. I want 5% interest. I want 0% interest. I will pay you off the rest of this in 10 years. All these different terms. And so it creates a win-win. And that's number 3, is that it is a tool for both buyers and sellers that can create a win-win. And so does it fit every transaction? No, it's not for everybody, but there are a lot of scenarios where it is a great solution.
Yeah, I agree. Let's just go over some of those types of creative financing deals, because we're talking about a broad swath of a way to do real estate transactions.
Right.
But this doesn't necessarily apply just to real estate. You can do creative financing and seller financing, all of these terms we're going to use with a myriad of products, quote unquote. You could buy a car this way. You could buy a business this way.
You can buy a couch this way.
You sure could.
You could creative finance anything you want.
Exactly.
Sky's the limit.
So what are some of those types of creative financing?
All right. So again, we're talking real estate. And so there are some specific types. And so we'll go through those quickly. Again, this is just high level, just to kind of, let's just talk about it. Number one is seller finance or owner finance or owner carry. And so simply put, an owner of a property owns it outright and they decide, you know what, I will be the bank and I will take payments on this property.
So you're moving from being a seller in that seat to being the lender, and now you're in the lender seat.
So essentially, instead of going to Chase Bank to go get a mortgage and you own the property outright, I'm buying it from you, like you become the bank and you have $500,000, the property's worth $500,000, you have that much equity, right? And so I'm going to pay you that $500,000 on terms. Usually most sellers won't do a 30-year note, but maybe you would.
But
yeah, you would for sure. The second one is the most popular, and it is also the biggest curse word in the industry, especially as a realtor, is subject to or sub to. It's the slang, the cool way, the cool kids are saying it that way. But subject to, so you're buying a property subject to the existing debt on the property. So there's two things. There is the property that you're purchasing, and then there is the lien on the property, the mortgage, the deed of trust. And so those are not one and the same. They are two separate things. And so if I'm buying your property, we're going to keep the lien, the mortgage, you're going to keep it, and I'm going to take over payments subject to.
Do you have to qualify for those payments when you do that?
Great question. No, you don't. Technically, you've already qualified for them. So I'm just taking over your debt.
Exactly.
Right? The third one is a wrap. And so this is more higher level. This is more of an investment strategy. As a seller, I can sell my property on a wrap. Current financing in place, current debt in place. I can wrap that financing and repackage it and sell it to you. Again, it's higher level. We've done that. I mean, it's a pretty fun way to do it. All of these options are more like chess versus checkers. You know,
Ooh,
more strategic,
I like that.
Where traditional is more checkers.
Yeah. Next one, lease option.
You got this one?
No.
I got this one? Okay.
Go.
A lease option. This one's more common. People have heard this before. But it is really, you still stay as a seller, you stay on as the owner and you are renting the property. You have two agreements. You have a lease, a rental agreement, and then you have an option agreement. That is the option to buy the property at a specified time, 2 years, 5 years, whenever it is. The person that's renting it is paying you an option fee, if you will, for the right to buy it at a predetermined price. Right?
Exactly. And I think that's the advantage to the buyer in a lease option is that you are locked in at a price. That price doesn't change then when you go to actually purchase it and put all the funds that you've been spending on rent. They're actually getting put towards the debt of the property.
Right. And there's different ways of structuring it as well. Again, sky's the limit. It's a great option for people that want to really have the idea and the value of home ownership, but maybe they have a couple of things they need to do to get their ducks in a row. They need to save some more funds. It locks in the price now. And so the risk to the seller is, what if the price goes up? But you're predetermined, you're locking it in. I mean, you could structure it where you don't like the price in, but as a general statement, high level, the value to the renter is that they get a place.
So now blow all the doors wide open with this last one because it is the most complex.
It is the most complex. And that is it's really just a vehicle for purchasing. And that is through a trust, an LLC or some form of an entity. And so because then if you have an entity, for example, you can sell shares of the entity. So if the entity owns the property, you could just simply come in and buy shares of the entity or buy the ownership of the entity. It's a little more tricky, and the trust is even higher level. We just did that. We did one like this recently where we did it through a trust. It is a great way. It's more of just liability protection for everyone.
Yeah.
That's why.
Another layer.
Yeah.
Yep.
It's another layer. But those are the ones we're talking about today.
Those are
There's other ways, but it's like, this is good enough.
Yeah, that's good enough
for today. for a simple podcast.
So let's talk about what it is and what it is not,
Right.
because I do think this is a portion of the podcast where we can bust some of the myths, but also challenge the audience of thinking about it and looking at it a different way. So let's talk first about what it is not. You take this one. It is not illegal.
It is not illegal. Subject to is not illegal. In the realtor space, so many people, as soon as they hear subject to, they think it's a scam. They think it's illegal. They think, oh my gosh, run for the hills. And it's just not the case. It is. I had a conversation with an attorney here 2 hours ago, and we were talking about an attorney that specializes in creative finance transactions. First of all, if it was illegal, that wouldn't be a statement.
Yeah.
An attorney
Lefty wants to get
would be
disbarred.
doing it if it was illegal, in my opinion. But an attorney, a licensed attorney, and talking about how this works. Is it in breach of contract? Yes. Technically, yes. And what does that mean? It's because of this thing called the due on sale, which we will go into. But the lender has the right, this is what makes it a breach, has the right to call the due on sale due if the breach of contract has happened. And so anytime a property has been transferred to an LLC, you buy a property and for estate planning purposes, you transfer it to an LLC or you transfer it to a trust.
Or you get married you go add your new spouse onto the title, but they didn't get added to the loan.
Yeah, so technically all of those things are the exact same thing. Those are all in breach of the original loan documents. But as long as you keep making the payments, oftentimes, and more often than not, you're good. The lender wants their money. Yeah. They don't want the property. They lend money. So number one, it is not illegal.
Yes. Okay, next one. It is not an assumable loan.
It's not the same.
Talk about the differences between those.
Yeah, so right now we see a lot of assumable loans. An assumable loan means if you're selling your house with an assumable loan and I, the buyer, come in, I have to come get qualified with your lender to take over the terms of to assume your current loan, where it's at. It is a great thing, but I still need my credentials. I need to qualify. I need to provide everything. And then we have to make the deal work. And it takes a lot of time. Assumable can take 6 months, 9 months, depending on paper pushing. I mean, they can be faster, but they are known, especially VA, assumable, they are known to be slow. So that is a subject to purchase an assumable loan? No.
No. All right, let's hit the next one, which it is not bad for the seller. I think there's so many opportunities for this to be really the best option for the seller.
Agreed.
Let's talk about one of those, which is a lot right now of boomers have properties and there's penalties if they have a windfall of cash and they could lose really important benefits, whether it's health benefits, benefits from pensions, if you Social Security, Medicaid, I mean, the list is long.
Yeah.
If you have a windfall of cash, then oftentimes you can lose some of those benefits. And so there's lots of boomers right now hanging on to properties with tons of equity, a lot of them paid off. They don't want to do that. So this is actually one of the best examples where this is a great option for somebody like that.
Right.
They can make mailbox money. They don't have to worry about the property anymore. They don't technically own it. And they also get the price that they often want, but they get to keep so many of those other benefits.
I have a friend in the community that her name's Ingrid, and that's what she does. She helps people in this situation where, has a heart for people that are getting older, they're aging, boomers, and helps them navigate this because it can be, I mean, if you don't realize it and you sell your house and then all of your benefits that you've been used to and living on are gone because you made $200,000 or whatever it is, that's a shame. So yeah, it is not bad for the seller. It can be really good for the seller, actually.
Exactly. It is not one size fits all. And I think that's where we love this space. We play in this space all the time, right? Travis talks about, I don't want to be in the sandbox. I want to be on the beach.
Yeah, don't give me walls.
Don't wall you in.
Boundaries.
And it really is. There's so many levers that you can hit to change the terms for the buyer, the seller. Everyone can get paid. You can pay out, transaction coordinators, you can pay out RMLOs, you can pay out agents, commissions, compensations, all that stuff. And it can honestly just be a win for everybody, but it's not one size fits all. It is truly sky's the limit.
Right. It is a way for everyone to be in the winning position. It's pretty amazing.
It's also not typically a cash heavy purchase. So talk about that, because it's kind of a caveat.
Yeah, I mean, some of them, they can be, but as a general statement, high level, it is not a ton of cash. Usually, like when we're evaluating a deal, and again, our deals that we're buying most likely are going to be a rental, that we would like to turn them into a rental, into our cash flow, portfolio. And so it's not a cash heavy deal. Normally it is 10% all in max, and that includes all fees. So that doesn't mean 10% to the seller necessarily, but again, it's a property by property basis. But what we run into a lot is, sellers, and rightfully so, I understand it. It's like if they've been on the market a long time, and so they are open to entertaining a creative financed offer, but they might have $200,000 in equity, and they're like, well, yeah, give me all my equity, and I will let you have the property. And it's like, well, that's where it's like price and terms. If you get your price, the buyer gets the terms. If you lower the price, you can have better terms. But so it is a teeter-totter.
And then I think finally, I wouldn't categorize it as a super simple or easy way to convey property. You definitely need to have education. You need to have a team. We've talked about transaction coordinators, RMLOs, attorneys.
All those.
Certainly. Yeah, it matters very much. It's not simple. It's not easy. And it's definitely one where you want to make sure you're doing things by the book.
Correct. Yep. Exactly. I mean, it is very doable as long as you have that team in place.
Yeah.
And that team isn't that hard to find. It just seems a little daunting, like saying it, but it is totally doable.
Yeah. Okay.
It's like what it is.
Right? I'm like, well, that was negative. Let's talk about all the great parts about creative and seller financing. We talked about a scenario where, a boomer might have a completely paid off property, but I also want to talk about the advantages of what it is when it's a no equity, low equity property. So it can be great for somebody who has low or no equity, a job's taken them somewhere else, and now they need to sell it. And if they're going to go on the market and sell it traditionally, they're looking at losing 40, 50, even more cost of sale. So it's great for a seller who is in a low equity or no equity position.
Yeah, it's great for somebody that wants mailbox money.
Yes.
And so, meaning like, if I have a property and I own it outright, and it's like, man, it's got $300,000 in equity, I would rather, I don't want to rent it. I don't want to be a landlord. I don't want to be in charge of the property. I don't want to fix toilets. I just want money in my pocket.
Yep.
And so this is a great solution, because you sell the property and they pay you every month. And you can there's stopgaps in place. You can put in servicing to make sure it's taken out, but you step in the seat as Chase Bank or whoever.
It can also be a really good option for sellers who are in pain. There's been a life event that's happened, and they are remote maybe and don't want to go through the trouble of selling it on the market and having to go through the whole home. I mean, you can sell this in a way where it can get you out of some of those pain points as a seller.
Yeah, absolutely.
And still be a benefit to you financially.
Correct. And it doesn't have to be a fire sale.
Yeah.
That's the difference. Oftentimes, like pre-foreclosure, for example, it's a great example of as an investor, those people are in pain. Something's happened to cause them to get there. And it's usually painful. And often, a lot of investors come in and say, hey, I see you're on the pre-foreclosure list. I'll give you 50 cents on the dollar.
Exactly.
Which is very normal. And sometimes that is the solution. It's like, okay, I just need out now, eject, let's be done. Creative financing can help with that. Maybe they have a decent rate. Maybe the terms are good.
It can also save your credit.
Right.
I mean, that buyer, can come in and catch up all of those back payments, and you can walk away with cash and having your credit still intact, where normally, you're not necessarily going to get that if you're selling to a wholesaler or investor.
Exactly. And you can pay a lot higher.
Who's undercutting you. Yeah.
If the terms are really good. So yeah, that's a great example. All right, last one. Hard to traditionally qualify buyers. So this one's funny because we are in that boat.
Yeah.
We're both self-employed. And so from a on paper standpoint, lenders hate us.
Oh my God.
We have great relationships with lenders, but if they're trying to underwrite us, to qualify for a deal, like we are challenging.
Very challenging. And honestly, 2 years ago, we went to get a traditional loan and we went through probably a 6-month process and gave them everything short of blood of our firstborn child.
No, I sent them that.
You did send them. We just mailed mail-in.
Yeah.
And we still were told we would not qualify. We can't do it. And so then a whole nother year later, we had a wizard who did get us approved. But truly,
Julian,
yes. This isn't necessarily, I think there's a bad reputation in the market of somebody who can't qualify traditionally. Maybe they're in a cash-based business, marijuana business here in Colorado.
Contracting.
Great example. Yeah, contracting. It doesn't necessarily mean that they can't make the payments or they're not a qualified buyer. It just means that traditional financing, which is typically backed by the government, Fannie Mae, Freddie Mac loans, they don't want to lend you money if you're not necessarily paying them taxes on paper.
Right. Credibility and lendability are different.
Yes. And we play the tax game and we play it really well. We pay ourselves as little as possible.
A reasonable salary. That's what it's called.
I don't think it's reasonable. And but we also, keep our taxes really low. So the government looks at that and they're like, well, you haven't paid us very much money. So we don't
That's the goal, right?
pay you very much money.
The goal is to play the game that's set forth in front of us and pay as little taxes as possible because that's the rules of the game.
Yeah.
Different podcast.
Yeah.
Yeah. I mean, but this fits for people that are in that box. All right. Do you want to talk about this?
Yes.
Because this is for an agent lens, right?
Yeah. Which I think is some of our audience. And so let's talk a little bit about what happens if you are a broker and you have somebody who gives you a seller financed offer, creative offer. Oftentimes right now in the market, we're seeing these come in as letters of intent. I want to talk about the difference between an offer and a letter of intent. If you have not had a conversation with the buyer or you haven't provided them a mortgage statement or information about the loan, if there's one in place, or information about owning it outright, it is not an offer. It is likely just a letter of intent. And there's tons of these blanket marketing pieces of paper going around.
And they're not bad.
No. And honestly,
they mean it.
A lot of them turn into closed transactions.
Absolutely.
But that is different than an offer. So as a broker, you are responsible for presenting every offer to your seller. So if I'm getting a letter of intent from a potential buyer, I'm calling them back and I'm saying, what are you looking for? What are the terms that you are offering? That will immediately separate out people from knowing what they're talking about to not really knowing what they're talking about or not being serious.
Very true.
And then you start collecting all of the information. So it's a mortgage statement. And this is where you can really work with your client, your seller, and say, this is what we're offering for terms. And you can kind of have that go back and forth. But the first thing to keep in mind as a broker is that there's a difference between an offer and a letter of intent.
Well, and that goes with if you're a seller and you get a text or you get a direct piece of mail or something that says, I'll buy your house on terms. Or are you open to terms? Or are you open to, I'll pay your price, give me terms, whatever it is.
Mm-hmm.
It probably is real, but the details aren't known yet.
Yeah. And so I think that's then the next piece of it is, collect the information, obviously talk to your client if you're getting, one of these offers yourself, and determine your limits and ask for help. We've talked about that several times this podcast. It's one of the most important pieces in creative and financing deals, which is you have to know your limits. You have to know when you need to go get help, and you have to have a repertoire of people that can help execute this for you because it's not simple. It is complex.
Absolutely.
Yeah. What about other considerations? Let's talk about the buzzwords and things where people automatically go and say, this is bad and here's why.
Well, we joked that the sub to or subject to was a curse word, especially in the realtor lens, in the real estate agent lens, which it is. But the ultimate curse word in all of real estate that I've always heard for the last going on, 16, 17 years now is due on sale. So we talked about that a little bit. We explained it. I don't need to go into more detail, but it is like the ultimate curse word. I've never known a single person that it's happened to. I know it does. It's like 1 in 1,000, 1 in 950, something like that as far as transactions. Usually it happens because somebody stops making the payments, they let their insurance lapse, they let the taxes not get paid, something like that, something for it to be flagged in the internal system of the bank and that says, whoa, what's going on? And so, yes, it is a clause in the deed of trust or in the mortgage documents that says, if you do this, then technically you're in breach of the contract and the lender has the right to call it due. The next one is servicing and RMLO. Servicing, we're all pretty familiar with this concept. It just seems a little different, but anytime you get a normal loan, oftentimes your loan is serviced by a different provider, Mr. Cooper,
Loan Care,
Lakeview, all these, PNC.
People should know, that is not your mortgage holder. That is the company that is servicing the loan. So they receive the payment from your bank account, and then they pay all the people. They pay your escrow. They pay sometimes some of your utilities can come out of that. They're paying the actual mortgage holder. It's not they're not actually holding the loan.
Right. Sometimes lenders do, like Chase will service their own. But oftentimes they don't. And so in a creative transaction, servicing is equally, if not more, important. And so the reason is because you want a third party to be managing all of those details.
Mm-hmm.
You want a third party to be, if there's an underlying note, you want the third party to be paying that on your behalf. And so the servicing is super important. And then an RMLO, a residential mortgage loan officer, or just LO in our world, we call it that. And it is important from a selling standpoint, because if I'm a seller and I'm selling creatively or seller finance to a buyer, I want them to be just high level qualified. And the reason being is because, first of all, I want to make sure that they are who they say they are and they make the money they make. I don't care about all the details. I don't care if they, have a 650 credit score. I want to know, do you make enough and are you good for it? Mm-hmm. And I need some third party to tell me that. And also because I don't want to be a predatory lender.
Yeah.
And in this, that's a really scary phrase. It is real.
But I think it's that extra layer of protection.
Absolutely.
And if you're doing that from the beginning, then it just helps in the long run.
It does. Exactly. It's just important. And so those two things are definitely important. Transaction coordinating and an attorney, those two pieces are also very important.
Yeah.
Oftentimes in a traditional transaction, we use a transaction coordinating person all the time, but they're really just hand-holding, making sure the dates and deadlines are held. And they're very important. In a creative space, they're even more important because there's other little nuances that are at place and happening. And so super important. And then an attorney, just to make sure you're doing everything correct.
Yeah.
Because it's all about paperwork and documentation and making sure that's all right. And
yeah.
So whether it's just drafting a deed of trust, drafting a promissory note, whatever it is.
And oftentimes those are going to be requirements. If you're a broker, if you're licensed, that's going to be a requirement of your managing broker. So always checking that and making sure you're doing things the way that your managing broker wants you to do them. And then finally, costs. I think there's misconceptions about, what it costs or who pays for what in a creative deal. Mm-hmm. What would you tell the audience about costs?
So, costs are similar to a normal transaction. They're all negotiable. They're negotiable in a normal one too, but they're not, it's customary versus, this where it's creative. So in costs in a creative transaction, the good example are the TC that I just talked about and the attorney. Those aren't always costs that a buyer and or a seller absorb in a transaction. Where in this, someone's going to pay for it. And so if you are a seller selling to a buyer on terms, you can easily say, hey, those are yours. We, on all of our buys that we are thinking about, we are assuming we're taking those on because
we're putting them in our numbers.
That's okay. Those are in our numbers. We are estimating $4,000 for these type of fees, and it's worth it.
And I want to clear the air too, because some of the audience would be brokers. You can still get paid. And I think that's one of the biggest questions as a broker, which is, well, do I still get paid? How do I get paid? Who pays me? And as much as we love our clients, we don't want to work for free. And you do put in a lot of effort. And then this creative transaction comes along and you're sitting there thinking, am I getting cut out or how does this work? You can absolutely still get paid. It doesn't really matter what bucket it comes from, the buyer's bucket or the seller's bucket. But at the end of the day, the majority of transactions, you still get paid.
And if it's like an investor that's doing this, they might try to squeeze you.
Well, yeah, they're going to negotiate.
They're going to negotiate. But yeah, I mean, you're right. You still have the opportunity to get paid.
Let's leave the audience with some resources because this is a ton of information and it is.
And we just scratched the surface.
Oh my gosh. We cracked the door open. And so truly, if you have interest in this subject and that's why you're here, it is important to go continue to dig into resources.
And I feel like we could sum it up in one person in one word.
Yeah.
You just go check out Pace Morby.
Yeah, follow his YouTube.
We are in his community with him, and we are friends with Pace. He is an amazing resource, a wealth of knowledge, and he is the forefront and leader in really just pioneering all things creative. He did not invent it, and some people think he did.
But he made it palatable. He made it so you can understand it.
Yeah, exactly. So I would just YouTube or Google Pace Morby subject to.
Yep.
And truly, or send us a DM. We're happy to talk about it, especially if you're here locally.
Yes. And we have resources here locally, including classes where, there are people here in the community trying to help agents level up their knowledge.
Right.
There's great resources. So feel free to send us a DM. How can people find you?
How can you practice it?
I have been.
You can find me on all the socials. I am at the Travis Hall.
And for best response time, I am at the Ingrid Hall on Instagram.
Yeah. She's on Instagram. I am too. That's the main one. Go there first. Let's just be real.
Yeah.
Instagram is where we are at, but technically we are most places that way.
Yes.
Cool. Well, thanks for listening along. If you like this, be sure to click the like button, click the follow button, and subscribe. We greatly appreciate that.
Yeah.
And until next time, have a great week. Thank you so much for listening to this week's episode of the Yoked Podcast. We hope you enjoyed it.
And as always, be sure to like, subscribe, and follow along as we drop a new episode each week.